Welcome to your Q&A session for the WGU Financial Management I exam. We'll break down practice questions one by one, why the right answer holds, why the others fail, and the concept tying it all together. This video covers Domain 1, working capital and the balance sheet, including how the balance sheet splits into assets, liabilities, and equity, how current assets are ranked by liquidity, gross, net and net operating working capital, ratios measuring liquidity and working capital, restricted versus relaxed investment policies, financing current assets through maturity matching. And just a quick reminder, our website has free study guides and practice questions ready to help you prepare for and pass your D364 exam. All you have to do is click the link in the description below to get started. So don't wait around, head over there now and start studying smarter, not harder today. Alright, let's dive in. Question 1. A financial analyst pulls two statements for a manufacturing company. The first is labeled as of December 31st and the second is labeled for the year ended December 31st. The analyst needs the one that reports the company's financial position at a single moment rather than activity across a span of time. Which statement fits that need and what feature identifies it? Your options are A. The statement labeled for the year ended because it accumulates totals over 12 months. B. Either statement because both report the same point in time position. C. The statement labeled as of because a balance sheet reports financial position at one instant. D. Neither statement because financial position can only be read from the statement of cash flows. Which one is it? Pause the video if you need more time. The correct answer is C. The statement labeled as of because a balance sheet reports financial position at one instant. C is correct because a balance sheet reports what a company owns and owes at a single date, which is exactly what as of language signals. The income statement reports a flow of revenue and expense across a period, marked instead by for the year ended. A is wrong because a statement labeled for the year ended is the income statement, which measures activity over a span rather than position at an instant. Accumulated period totals are the opposite of a point-in-time snapshot. B is wrong because the two statements measure different things. One captures position at a single instant and the other captures a flow over a period, so they cannot report the same thing. D is wrong because financial position at a moment is precisely what the balance sheet reports. The statement of cash flows, like the income statement, covers a period of activity rather than a single instant. A balance sheet answers a narrow question: what a company owns, owes, and has left for owners, all measured at a single instant in time. Every figure on it is a snapshot taken at the close of business on one specific date, not a total built up over weeks or months. The cleanest way to see this is a photograph versus a video. The balance sheet is the photograph, freezing the company on one named day. The income statement is the video, recording revenue and expenses as they flow across a quarter or a year. The wording on each statement is the giveaway. A balance sheet is headed as of a date, pointing to a single instant. An income statement is headed for the period ended, pointing to a span, and exam questions often hide the answer in that exact phrasing. Picture an analyst opening two files for the same manufacturer, one labeled as of the last day of the year, listing cash, receivables, inventory, debts, and equity at that final moment. The other labeled for the year then ended, listing sales earned and costs absorbed across all 12 months. Comparing two balance sheets shows what changed, but only the income statement explains why. The photograph and the video aren't rivals. The video bridges one photograph to the next, and never mistake a single instant for a stretch of time. Question 2. A company's balance sheet lists its current assets from top to bottom in this order: cash, marketable securities, accounts receivable, inventories. A newly hired analyst asks what logic drives that particular sequence. Which explanation is correct? Your options are: A. The assets are ordered by liquidity from the most quickly converted to cash down to the least. B. The assets are ordered by dollar value from the largest balance to the smallest. C. The assets are ordered alphabetically by account name. D. The assets are ordered by the date each was acquired, oldest first. Take a second. Which answer would you pick? The correct answer is A. The assets are ordered by liquidity from the most quickly converted to cash down to the least. A is correct because current assets are listed in order of liquidity, meaning how quickly and easily each converts to cash. Cash sits at the top because it is already spendable, and inventory sits at the bottom because it must be sold before it becomes cash. B is wrong because dollar value does not set the ordering. A large inventory balance still appears below a smaller cash balance because the sequence follows liquidity, not size. C is wrong because alphabetical order would not produce the sequence, and balance sheets do not arrange current assets by account name. The driver is how fast each asset turns into cash. D is wrong because acquisition date has no bearing on where a current asset appears. The sequence reflects convertibility to cash, not purchase history. Current assets appear on the balance sheet in a deliberate order, and that order follows one rule: liquidity, meaning how quickly and cheaply an asset converts to cash. Cash sits first because it already is money. Marketable securities come next since they convert with just a phone call and a day or two. Accounts receivable follows, waiting on customers to pay, often in 30 to 60 days. Inventory sits last because it must first be sold before it becomes cash or receivable. Think of marketable securities as cash taking on a brief side job while it waits to be called back into action. Picture a regional distributor, a modest cash balance, a slice of securities, a large block of receivables, and an even larger block of inventory. The shape of that stack reveals whether liquid strength sits near the top or is buried lower down. Two companies can report identical current assets, yet one holds cash and receivables while the other holds inventory. The ordering exists to make that difference visible at a glance. Question 3. A company reports total assets of $740,000 and total liabilities of $455,000. A lender reviewing the file wants to know the owner's residual claim on the company. What is the owner's equity? Your options are B. $285,000. C. $455,000 odd. D. The figure cannot be found without the income statement. Before I reveal it, which one do you think is right? The correct answer is B. $285,000. B is correct because the accounting equation states that assets equal liabilities plus owner's equity. So equity equals assets minus liabilities. Here that is $740,000 minus $455,000, which is $285,000. A is wrong because adding assets and liabilities together gives $1,195,000, but that reverses the relationship. Equity is what remains after subtracting liabilities from assets, not the sum of the two. C is wrong because the figure $455,000 is total liabilities, not equity. The owner's residual claim is the difference between assets and liabilities. D is wrong because the balance sheet alone is enough. The accounting equation supplies equity directly once assets and liabilities are known, with no need for the income statement. Assets equal liabilities plus owner's equity. This isn't a rule someone imposed. It's a logical consequence of what those three words actually mean. Every asset a company holds had to come from somewhere. Either it was borrowed, creating a liability, or it came from the owners, creating equity. List what the company holds on one side and who has a claim on it on the other, and the two sides must match. Equity is not a pile of cash the owners set aside. It's a residual, whatever is left after creditors' claims are subtracted from assets. If a company holds $200,000 in assets and owes $100,000 to creditors, the owner's stake is exactly the leftover $100,000. Because equity is the flexible, last in-line figure, it absorbs whatever happens to asset values. If assets lose value, equity shrinks, since creditors are still owed the same amount. If assets gain value, that gain flows entirely to the owners. A balance sheet never truly hides a number, because the identity always supplies the missing quantity from the other two. Remember that equity is a residual, not a hoard, and you can reconstruct the whole story of who owns what. Question 4. A controller is sorting 4 items into balance sheet categories: a bond that matures in 8 years, a warehouse mortgage with 12 years remaining, a share of common stock, and a bank loan due in 90 days. Which of these 4 is correctly classified as a current liability? Your options are A. The bond maturing in 8 years, B. The 12-year warehouse mortgage, C. The share of common stock, D. The bank loan due in 90 days. What's your answer? Commit to one before I continue. The correct answer is D. The bank loan due in 90 days. D is correct because a current liability is an obligation due within 1 year, and a bank loan due in 90 days falls well inside that window. Short-term bank borrowing of this kind is recorded as notes payable among the current liabilities. I was wrong because a bond maturing in 8 years comes due far beyond the 1-year cutoff, which makes it long-term debt rather than a current liability. B is wrong because a mortgage with 12 years remaining is a long-term liability. Only a portion coming due within the next year would be treated as current, and the mortgage as described as long-term. C is wrong because common stock is part of owner's equity, not a liability at all. It represents an ownership claim rather than an obligation the company must repay. The line between a current liability and a long-term one is drawn at a single point, 1 year. If it's due within 12 months, it's current. If it's due further out, it's long-term. This boundary matters because of liquidity. Money owed within the year presses directly on the company's near-term cash and resources, while money owed years from now doesn't yet. A company can look fine on total debt but still be squeezed if too much comes due at once. Current liabilities include accounts payable owed to suppliers, accruals like unpaid wages and taxes, and notes payable, which is short-term borrowing due within the year. Long-term liabilities hold obligations with distant due dates, most commonly bonds and long-term loans like a mortgage. Picture a controller sorting 3 obligations: a bond maturing in 8 years, a warehouse mortgage with 12 years left, and a banknote due in 90 days. Only the 90-day note falls within the year, so it alone is current. The bond and mortgage both stretch past that mark, so both are long-term. Watch for common stock sneaking into these lists. It is not a liability at all, current or long-term, but part of owner's equity. Always ask first whether something is even an obligation, and only then whether it's due within a year or beyond one. Question 5. At a distribution company, accounts payable and accrued wages both rise on their own as sales and purchasing volume climb, without management ever renegotiating a financing agreement. What term best captures these 2 items? Your options are A. Discretionary financing arranged with a lender, B. Spontaneous current liabilities, C. Permanent current assets, D. Non-operating marketable securities. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Spontaneous current liabilities. B is correct because accounts payable and accruals grow and shrink automatically with the level of business activity, which is the defining feature of spontaneous current liabilities. No fresh borrowing decision is made each time they change. A is wrong because discretionary financing describes a deliberate borrowing choice, such as drawing on a banknote. Payables and accruals require no such decision, so they are spontaneous rather than discretionary. C is wrong because permanent current assets are assets, not liabilities, and describe a baseline asset level rather than obligations that rise with purchasing. The items described are amounts owed, which places them on the liability side. D is wrong because marketable securities are a current asset held as a near-cash investment. Accounts payable and accrued wages are obligations the company owes, so they cannot be securities. As a company's sales climb, something interesting happens. Accounts payable and accrued wages both rise on their own, with no one arranging financing at all. That self-adjusting quality is what makes them spontaneous current liabilities. Accounts payable is money owed to suppliers for goods bought on credit, and it swells automatically when a business buys more to sell more. Accruals work the same way. Accrued wages pile up between paydays, and accrued taxes bill between filing dates, simply because activity increased. The word spontaneous means the balance appears naturally in step with sales, rather than from a deliberate decision to borrow. This sets up a key distinction. Spontaneous liabilities scale with the business by themselves, while discretionary financing, like a bank loan, requires management to choose and arrange it. Picture a distributor entering a busy stretch. Purchasing from suppliers doubles and payroll rises as shifts get added, without a single new agreement being signed. Accounts payable and accrued wages both climb automatically, cushioning the cash strain of the season. Because payables and accruals move predictably with sales, they can be forecasted almost mechanically. The mistake is assuming every liability reflects a deliberate choice. These two are simply the automatic residue of doing business. Question 6. A finance team reviews 4 balance sheet items and wants to identify the one that reflects a deliberate management decision to borrow, rather than a balance that arises naturally from daily operations. Which item fits? Your options are A. Accounts payable owed to suppliers, B. Accrued wages owed to employees, C. Notes payable owed to the bank, D. Inventories held for sale. Which would you go with? Lock it in before the reveal. The correct answer is C. Notes payable owed to the bank. C is correct because notes payable represent short-term borrowing that management deliberately chose to arrange, such as a bank loan or a draw on a line of credit. That decision is discretionary, unlike balances that build up on their own. A is wrong because accounts payable arises spontaneously when the company buys from suppliers on credit. It grows with purchasing without any separate borrowing decision. B is wrong because accrued wages build up automatically as employees work between paydays. No financing negotiation creates that balance, so it is spontaneous rather than discretionary. D is wrong because inventories are an asset, not a form of financing. Holding goods for sale is an operating choice about stock levels, not a decision to borrow. Notes payable stands apart from other liabilities for one reason. It exists only because management chose to arrange it. That element of choice is what makes it discretionary financing, and the contrast with the liabilities around it is worth grasping. Accounts payable and accrued wages arise automatically from operating, buying on supplier terms or running payroll, with nobody weighing a decision. Notes payable is the opposite. A company borrows only after management looks at its cash needs and chooses that path over issuing stock, drawing down cash, or using long-term debt. A jump in payable simply says the company is purchasing more, but a jump in notes payable says management actively went out and borrowed. Because that reflects a financing choice rather than an operating necessity, measures meant to capture what the core business requires deliberately exclude it. Picture two companies with identical operations, sales, inventory, receivables, and payables. One funds a cash gap with a banknote, the other by drawing down its own cash. Their operations are indistinguishable, yet only one shows notes payable, because the difference lives entirely on the financing side. That single question, spontaneous or discretionary, sorts every liability into the part that tracks the business automatically and the part that reflects management's hand on the financing levers. Question 7. A company's balance sheet shows retained earnings of $2,000. A junior manager concludes that the company therefore has $2 million of cash available to spend. What is the flaw in that conclusion? Your options are: A. Retained earnings is cumulative reinvested profit, not a pool of cash the company is holding. B. Retained earnings equals only this year's net income, so it reflects a single period. C. Retained earnings is money the company owes to its shareholders as a liability. D. Retained earnings can never fund the purchase of assets, so the figure is meaningless. Don't overthink it, which one feels right? The correct answer is A. Retained earnings is cumulative reinvested profit, not a pool of cash the company is holding. A is correct because retained earnings is an equity account tracking the total profit reinvested in the business over its whole life, minus dividends paid. That profit has long since been spent on inventory, equipment, or debt reduction, so it is not a stack of cash. B is wrong because retained earnings is cumulative across the company's entire history, not a single year. The most recent year's profit is only the latest addition to a running total. C is wrong because retained earnings is part of owner's equity, not a liability owed to shareholders. It is a residual ownership claim, not a debt carrying a repayment obligation. D is wrong because reinvested profit is exactly what funds assets over time. The account is far from meaningless. It simply is not the same thing as cash on hand. The most misread line in equity is retained earnings, and the mistake is always the same, treating it as a stash of cash sitting in a vault somewhere. Retained earnings is the cumulative total of every dollar of profit the company has ever earned, minus every dollar ever paid out as dividends. A running tally since the company's founding that lives in the equity section. When profit isn't distributed, it doesn't drift into a savings account labeled retained earnings. It gets put to work buying inventory, purchasing equipment, paying down debt, and funding receivables. So by the time the balance sheet is drawn, that profit has long since become other assets. Cash sits at the top of current assets and answers how much spendable money is on hand right now. Retained earnings sits in equity and answers how much lifetime profit was reinvested. A company can have huge retained earnings and little cash, or the reverse. Whenever a question describes retained earnings as money set aside or held in reserve, that's the trap. The real cash position is found on the cash line and nowhere else. Question 8. A financial manager describes owner's equity as a segregated fund of cash the company keeps on the side for its shareholders. A colleague pushes back on that description. Which correction is accurate? Your options are: A. The description is accurate. Equity is a cash fund reserved for shareholders. B. Equity includes only common stock and leaves out retained earnings. C. Equity is a liability the company must repay to shareholders on demand. D. Equity is a residual claim equal to total assets minus total liabilities, not a cash fund. Got a guess? Lock it in. The correct answer is D. Equity is a residual claim equal to total assets minus total liabilities, not a cash fund. D is correct because owner's equity is what remains after subtracting liabilities from assets, a residual claim rather than a segregated pile of cash. It measures the owner's stake in the company, not a specific bank balance set aside for them. A is wrong because describing equity as a cash fund is exactly the misconception being corrected. Equity is a residual figure from the accounting equation, not money parked in an account. B is wrong because equity includes retained earnings alongside common stock and paid-in capital. Leaving retained earnings out would understate the owner's claim. C is wrong because equity is an ownership claim, not a liability. Creditors are repaid before owners, and equity carries no fixed repayment obligation the way a debt does. Owner's equity has a formal definition: the owner's residual claim on a company's assets. That word residual is the key to understanding both the risk and the reward of ownership. Equity is what remains for owners after everyone else with a claim on the company has been paid. It's calculated as total assets minus total liabilities, and the leftover amount belongs to the owners. Picture a company winding down and selling everything it owns. Creditors like suppliers, lenders, and bondholders are paid first, and only after they're fully satisfied do owners receive whatever is left. Standing last in line cuts both ways. If assets fall below debts, owners can be left with nothing, since equity absorbs the shortfall first. But once creditors' fixed claims are paid, every remaining dollar belongs to the owners, with no ceiling on the upside. So think of equity as a claim, not a cash balance. And remember which claim it is, the last one paid, and the one that swings with the value of the business. Question 9. A corporation's equity section lists common stock, paid-in capital, in excess of par, and retained earnings. An investor wants to know which of these represents profit the company earned and chose to reinvest rather than pay out to shareholders. Which line is it? Your options are A. Retained earnings, B. Common stock, C. Paid-in capital in excess of par, D. All three represent reinvested profit equally. Which one is it? Pause the video if you need more time. The correct answer is A. Retained earnings. A is correct because retained earnings is the cumulative net income the company has earned over its life minus all dividends paid, reinvested in the business. It is the only one of the three that comes from operating profit rather than from issuing shares. B is wrong because common stock reflects the par or stated value received when shares were first issued to investors. It comes from selling ownership, not from earning and keeping profit. C is wrong because paid-in capital in excess of par is the amount investors paid above par value when they bought shares. Like common stock, it comes from share issuance rather than from reinvested earnings. D is wrong because the three lines have different origins. Only retained earnings comes from reinvested profit, while the other two come from issuing stock. The equity section of a balance sheet isn't one number. It's built from pieces with different origins. Knowing where each piece came from is the key to reading it correctly. Three common lines make up equity: common stock, paid-in capital in excess of par, and retained earnings. The first two record contributed capital from investors. The third records earned capital from company profits. Common stock captures the par value received when shares were issued, and paid-in capital captures everything investors paid above that par. Together they answer one question: how much did investors put in? Retained earnings is entirely different. It's cumulative profit kept rather than paid out as dividends. A company with large paid-in capital but small retained earnings raised most of its equity from investors. One with small paid-in capital but large retained earnings built its equity through years of accumulated profit. If you want to know how much equity came from profit rather than shareholder investment, retained earnings is the only line that answers it. Contributed capital, common stock plus paid-in capital, is what owners paid in. Earned capital, retained earnings, is what the business made and kept. Never assume the two overlap. Always trace an equity figure back to its true origin. Question 10. A startup lists total current assets of $180,000 and net fixed assets of $220,000 with no other assets on its books. Its total liabilities are $250,000. Using the accounting equation, what is the company's owner's equity? Your options are A. $650,000, B. $250,000, C. $150,000, D. $430,000. Take a second. Which answer would you pick? The correct answer is C. $150,000. C is correct because total assets are current assets plus net fixed assets, which is $180,000 plus $220,000 or $400,000. Equity equals assets minus liabilities, so $400,000 minus $250,000 leaves $150,000. A is wrong because the figure $650,000 adds liabilities to total assets instead of subtracting them. Equity is the residual after liabilities are removed, not the sum. B is wrong because the figure $250,000 is total liabilities, not equity. Equity is the portion of assets left over once liabilities are covered. D is wrong because the figure $430,000 comes from mixing up the components, such as subtracting liabilities from only the fixed assets. Total assets are $400,000 and equity is $150,000. A balance sheet is built in layers, where every subtotal is just the sum of the pieces below it, and every grand total is just the sum of the subtotals above it. On the asset side, cash, marketable securities, accounts receivable, and inventories add up to total current assets, and that subtotal plus net fixed assets gives total assets. The other side mirrors this. Current liabilities add to long-term debt for total liabilities, and total liabilities plus owner's equity produce the grand total on that side, which must equal total assets. Picture two towers of nested boxes, one for assets and one for liabilities and equity, each box built from the sums beneath it, meeting at the top where total assets must equal total liabilities plus equity. Once you build the true total assets and total liabilities, any missing figure like owner's equity falls out with a single subtraction, so always sum every piece before you solve. Question 11. A bakery bought several delivery vans a few years ago. On the current balance sheet, the vans appear under net fixed assets at a figure well below their original purchase price. What best explains the lower figure? Your options are A. The vans were reclassified as inventory once their value dropped. B. Accumulated depreciation has been subtracted from the van's original cost. C. The vans were sold and replaced with cheaper models during the year. D. Fixed assets are always recorded at their estimated resale value. Before I reveal it, which one do you think is right? The correct answer is B. Accumulated depreciation has been subtracted from the van's original cost. B is correct because net fixed assets are reported at original cost minus the accumulated depreciation taken over the years the assets have been in service. The vans show a lower figure because depreciation has steadily reduced their book value. Is wrong because vehicles a company uses in operations for years are fixed assets, not inventory. Inventory is goods held for sale, and reclassifying used vans that way would misstate the balance sheet. C is wrong because nothing in the situation says the vans were sold. The reduced figure reflects depreciation on the same vans, not a swap for cheaper vehicles. D is wrong because fixed assets are carried at cost, less accumulated depreciation, not at estimated resale value. Book value and current market value can differ by a wide margin. A delivery van bought years ago shows up on today's balance sheet at less than its purchase price, and nothing has gone missing. The answer is hiding in the phrase net fixed assets. Fixed assets are the long-lived, productive things a company uses to operate, like land, buildings, machinery, and vehicles. Net means something has been subtracted from cost, and that something is accumulated depreciation, the running total of value chipped away each year the asset serves the business. Picture the van's original cost, then a slice of accumulated depreciation subtracted for each year of service. What's left is net fixed assets, the book value, and it naturally sits below the original price tag. The test is intended use and time horizon, not cost. Vans and ovens are kept for years, so they're fixed assets, while flour and inventory are meant to be sold within the year, making them current assets, even if that inventory is expensive. Seeing a fixed asset shrink year over year isn't a red flag. It's depreciation working exactly as intended. Just never mistake that book value for what the asset could actually sell for today. Question 12. A company pays a full year of insurance premiums up front and records $40,000 of prepaid insurance within current assets. Over the coming months, what most likely happens to this asset? Your options are: A. It is reclassified as a long-term asset as the year progresses. B. It converts directly into cash paid back to the company. C. It becomes part of retained earnings at year end. D. It is used up as the coverage period passes, converting to an expense. What's your answer? Commit to one before I continue. The correct answer is D. It is used up as the coverage period passes, converting to an expense. D is correct because a prepaid expense is a current asset consumed as the service period elapses. As each month of insurance coverage passes, part of the prepaid balance converts into an expense. A is wrong because a prepaid expense does not migrate to the long-term asset section over time. It shrinks towards zero as it is used up within the operating period. B is wrong because prepaid insurance does not turn back into cash. The company already paid the cash out, and the asset represents coverage it will consume, not money it will receive. C is wrong because retained earnings is a cumulative equity account, not where a used-up prepaid asset lands. The prepaid balance becomes an expense as coverage is consumed. Most current assets follow a simple path. They eventually turn into cash. Prepaid expenses break that pattern, and understanding why reveals a key idea about what an asset really is. Receivables get collected, inventory gets sold, and securities get liquidated, all eventually becoming cash. Prepaid expenses are the exception. They are current assets that never convert into cash at all. When a company pays a year of insurance up front, it hasn't lost that money, it has purchased future coverage. That right to future benefit is the asset, and it counts as current because the coverage will be used up within the operating period. Each month, a slice of the prepaid asset is consumed and moves onto the income statement as insurance expense. The balance shrinks steadily towards zero as the coverage period elapses, feeding the income statement rather than the cash account. A prepaid expense never turns back into cash, and it never migrates into long-term assets. It simply converts from asset to expense over its coverage period, and that's the distinction worth remembering. Question 13. A company holds treasury bills and high-grade commercial paper it bought with cash it did not need immediately, and it can sell them quickly whenever cash is required. Where do these holdings belong on the balance sheet, and what role do they play? Your options are: A. Under fixed assets, because securities are long-term investments. B. Under current assets as marketable securities, a near cash reserve. C. Under current liabilities because they must eventually be sold. D. Under owner's equity because they represent ownership stakes. Pick one, trust your gut. Here's your chance to test yourself. The correct answer is B. Under current assets as marketable securities, a near cash reserve. B is correct because marketable securities are safe, liquid instruments a company parks surplus cash in and sells as soon as it needs the cash. They sit near the top of current assets, just below cash, as a near cash reserve. A is wrong because these instruments are short-term and highly liquid, not long-term productive assets. Fixed assets are items like plant and equipment used for years, not treasury bills held briefly. C is wrong because marketable securities are something the company owns, so they are an asset, not a liability. Selling them brings cash in rather than requiring a payment out. D is wrong because holding treasury bills or commercial paper is a lending or investment position, not an ownership stake in the issuer recorded as equity on the holder's books. A company rarely wants a pile of cash sitting completely idle, earning nothing. Marketable securities are the standard fix, safe, liquid, interest-paying instruments like treasury bills or commercial paper that a company buys with spare cash and sells the moment it needs that cash back. Picture marketable securities as cash that has stepped out to work a temporary side job. It earns a small return while remaining ready to come back the instant the business needs money, combining the safety of cash with the productivity of an investment. On the balance sheet, marketable securities sit in current assets right below cash, ranking ahead of receivables and inventory because they can be sold so quickly with so little risk. They are an asset the company owns, never liability. Holding a treasury bill or commercial paper means the company is owed money, not the other way round. A subtler point matters later. A minimal cushion of near cash is an operating necessity, while a large block held as surplus funds is more of a financial investment. That distinction is why some analyses treat excess securities differently from the rest of current assets. The everyday cycle is simple. Park surplus cash, earn a little return, and convert back to cash exactly when payroll or a supplier payment comes due. Marketable securities are a liquidity tool first and an investment second. So never mistake them for a liability or treat a speculative block the same as a small operating cushion. Question 14. A furniture manufacturer keeps a supply of lumber in its storeroom and also owns the cutting machines on its production floor. How should each item be classified on the balance sheet? Your options are A. Both are fixed assets, since both support production. B. Both are current assets, since both are used in operations. C. The lumber is a current asset and the cutting machines are fixed assets. D. The lumber is a fixed asset and the cutting machines are current assets. Which would you go with? Lock it in before the reveal. The correct answer is C. The lumber is a current asset and the cutting machines are fixed assets. C is correct because the lumber is raw material the company will use up making products within the operating period, which makes it inventory, a current asset. The cutting machines are long-lived equipment used for years, which makes them fixed assets. A is wrong because only the machines are fixed assets. Raw material consumed within the operating cycle is inventory, a current asset, even though it feeds production. B is wrong because the cutting machines are not current assets. They serve the business for years rather than being used up within a year. Only the lumber is current. D is wrong because the classification is reversed. Lumber consumed in production is a current asset and machinery used for years is a fixed asset. Lumber and a cutting machine sit side by side on a furniture maker's floor, looking like part of the same operation, but on the balance sheet, they split into completely different categories, and the reason why reveals the real test for classifying any asset. The classification has nothing to do with what the asset is made of or how much it costs. It comes down to one question: how does the company intend to use this asset and over what stretch of time? The lumber is raw material consumed in production within the normal operating period, so it's a current asset. The cutting machine is bought to last for years, providing productive capacity across many cycles rather than being used up in one, which makes it a fixed asset. The same logic sorts a bakery cleanly. Flour, sugar, and butter are current assets bound for this week's production, while ovens, mixers, and delivery vans are fixed assets kept and used for years. Cost and durability never decide the classification. The single question is whether an asset will be used up or sold soon, making it current, or held to keep producing for years, making it fixed. Question 15. A controller lists these year-end balances: cash $15,000, short-term investment securities $25,000, accounts receivable $110,000, inventories $140,000, and warehouse and trucks net of depreciation $310,000. What is the company's total current assets? Your options are A. $290,000, B. $600,000, C. $310,000, D. $165,000. Don't overthink it. Which one feels right? The correct answer is A. $290,000. A is correct because current assets are cash, short-term securities, receivables, and inventories $15,000 plus, $25,000 plus, $110,000 plus $140,000, which is $290,000. The warehouse and trucks are fixed assets and stay out of that total. B is wrong because the figure $600,000 is total assets. Adding the $310,000 of net fixed assets to the $290,000 of current assets. The question asks only for current assets. C is wrong because the figure $310,000 is the net fixed assets, the warehouse and trucks. Those are long-term assets, not current assets. D is wrong because the figure $165,000 omits one or more current asset lines. All four current asset items together sum to $290,000. When a problem asks for total current assets, the real task isn't addition. It's sorting a jumbled list into the right bucket before you add anything at all. Total current assets includes only the liquid, short horizon resources, cash, marketable securities, accounts receivable, inventories, and prepaid expenses. These add together into the current asset subtotal, and nothing else belongs there. Picture the balance sheet itself. Current assets sit in their own section, and long-lived assets like the warehouse, trucks, and machinery sit below in a completely separate section. The single most common error is folding net fixed assets into the current total. A warehouse or fleet of trucks is real and valuable, but it can't be turned to cash without disrupting operations. So it belongs to total assets, not the current asset subtotal. The reliable method: label every balance current or fixed first, then sum only the current ones. That discipline is exactly what keeps the fixed asset line from sneaking into a total where it doesn't belong. Question 16. A company owes $90,000 in accounts payable and accruals due within the year, a $40,000 banknote due in 6 months, and a $300,000 bond that matures in 10 years. Which amount represents its long-term liabilities? Your options are A. $130,000, B. $430,000, C. $90,000, D. $300,000. Got a guess? Lock it in. The correct answer is D. $300,000. D is correct because long-term liabilities are obligations due more than a year out. Only the $300,000 bond maturing in 10 years qualifies, so long-term liabilities equal $300,000. A is wrong because the figure $130,000 combines the payables, accruals, and the 6-month note all of which are current liabilities due within a year, not long-term. B is wrong because the figure $430,000 is total liabilities, current plus long-term together. The question asks specifically for the long-term portion. C is wrong because the figure $90,000 is the accounts payable and accruals, which are current liabilities. The bond is the long-term item. The liability side of the balance sheet works just like the asset side, but it's pointed at what a company owes instead of what it owns. Obligations are stacked by timing, soonest at the top. Current liabilities are everything owed within the year. Long-term liabilities are obligations due further out, like bonds or a mortgage. Add the two together and you get total liabilities, which plus owner's equity equals total assets. The judgment that trips people up: an obligation is classified by when it's due, not by what it's called. A bond maturing this year is current. A bond maturing in 10 years is long-term. The maturity is the deciding fact, not the label. Take a company with payables, accruals, and a banknote all due within months, plus a bond maturing a decade out. Only the bond crosses the 12-month line, so it alone is the long-term liabilities figure, while the rest sit in current liabilities. The liability side is a maturity structure, near-term obligations stacked above long-term ones. Reading it well means classifying by due date and knowing exactly which subtotal a question is asking for. Question 17. A supplier ships goods to a retailer and allows payment 30 days later rather than requiring cash on delivery. On the retailer's balance sheet, the amount owed appears as accounts payable. What is this financing arrangement commonly called? Your options are a discretionary bank loan, B, trade credit extended by the supplier, C, an accrued expense, D, a marketable security. Which one is it? Pause the video if you need more time. The correct answer is B, trade credit extended by the supplier. B is correct because when a supplier lets a buyer pay later for goods already delivered, the supplier is effectively lending the buyer the value of those goods for the length of the payment term. That is trade credit and it appears as accounts payable. A is wrong because a bank loan is a deliberate borrowing arrangement recorded as notes payable. Accounts payable arises automatically from buying on supplier terms, not from arranging a loan. Sal is wrong because an accrued expense is an obligation for something like wages or taxes already incurred but unpaid. Buying goods on supplier terms is trade credit, recorded as accounts payable. D is wrong because a marketable security is a current asset the company owns, not an amount it owes. Accounts payable is a liability, the opposite side of the balance sheet. When a supplier ships goods and lets you pay 30 days later instead of demanding cash up front, that supplier is quietly acting as a lender. The amount owed shows up as accounts payable, and the arrangement behind it is called trade credit. The mechanics are simple. A company receives inventory now but doesn't pay until the end of the term, often 30, 60, or 90 days later. During that window, it holds both the goods and its cash, so the supplier has effectively lent it that value. What makes trade credit remarkable is that it usually carries no explicit interest and requires no loan application or negotiation. It appears automatically as a byproduct of buying on terms, which is why it's called a spontaneous source of financing, expanding right alongside a company's purchasing. This framing separates accounts payable from two things it resembles. It's not a bank loan, which is deliberate, negotiated, and usually interest-bearing, recorded as notes payable. And it's not an accrued expense, which comes from obligations like wages or taxes rather than purchasing goods on supplier terms. Picture a retailer receiving merchandise on 60-day terms before a selling season. The goods hit the shelves immediately, but payment isn't due for 2 months. So the retailer can sell to its own customers and collect cash before ever paying the supplier. Question 18. A company's balance sheet lists accrued wages of $18,000. A trainee assumes this means the company has collected $18,000 it can now spend. What is the correct interpretation of accrued wages? Your options are: A. It is an obligation for work already performed but not yet paid to employees. B. It is cash the company received from employees during the period. C. It is a current asset representing wages owed to the company. D. It is a long-term liability payable over several years. Take a second. Which answer would you pick? The correct answer is A. It is an obligation for work already performed but not yet paid to employees. A is correct because accrued wages are an expense already incurred. Employees have worked but payday has not arrived, so the amount is owed and unpaid. It is money about to go out, not money coming in. B is wrong because the word accrued does not mean collected. No cash came in from employees. The company owes them for work already done. C is wrong because accrued wages is a liability, not an asset. It is something the company owes, not something owed to the company. D is wrong because accrued wages is a current liability settled at the next payroll, not a long-term obligation spread over years. The word accrued trips people up because it sounds like money coming in, but it actually means the opposite. An accrued expense is something the company already owes but hasn't paid in cash yet. Think of accrued wages this way. Employees have already done the work but payday hasn't come. The company owes them money that hasn't left its hands yet. So the direction of the cash is outward, not inward. Picture the balance sheet itself. Work performed creates an obligation, not an asset. And that obligation sits as a current liability because the company will settle it soon, at the next payroll or tax filing. Getting the direction right settles several classification questions at once. An accrued wage cannot be an asset since the company owns nothing as a result of it. It cannot be cash collected since no cash has moved yet. And it's a current liability, not a long-term one, because it gets settled quickly. Whenever you see the word accrued, translate it as incurred but not yet paid, and ask which way the money is moving. For wages and taxes, it always moves outward from the company, which is exactly why accruals belong on the liability side. Question 19. A company's balance sheet shows total assets of $600,000 and total owners' equity of $270,000. For the balance sheet to balance, what must total liabilities equal? Your options are A. $87,000, B. $270,000, C. $330,000, D. The amount cannot be determined from these figures. Before I reveal it, which one do you think is right? The correct answer is C. $330,000. C is correct because the accounting equation requires assets to equal liabilities plus equity. So liabilities equal assets minus equity. Here that is $600,000 minus $270,000, which is $330 minus. A is wrong because the figure $870,000 adds equity to assets rather than subtracting it. Liabilities are the difference between assets and equity, not their sum. B is wrong because the figure $270,000 is owner's equity, not liabilities. Liabilities are the remaining claim after equity is removed from assets. D is wrong because the figures are sufficient. The accounting equation determines liabilities directly once assets and equity are known. The balance sheet has a quiet superpower. It never leaves you truly stuck on a missing number. Because assets always equal liabilities plus owner's equity, any two of these three master quantities will always hand you the third. The rearrangements follow directly from the identity. To find equity, subtract liabilities from assets. To find liabilities, subtract equity from assets. And to find assets, simply add liabilities and equity together. A well-designed distractor might suggest you need more data, but that's false. The equation is complete on its own. Total assets and total equity together pin down total liabilities exactly, with no outside information required. This is why it's called a balance sheet. Add up the asset side, add up the liabilities plus equity side, and the two totals must match. If they don't, something was misclassified, mistyped, or omitted. Treat any missing master figure as a plug the equation will supply, and resist the instinct that more information is needed. Two of the three always determine the third, turning what looks like a data hunt into one confident subtraction. Question 20. Which of the following correctly pairs a balance sheet section with an item that belongs in it? Your options are A. Current liabilities paired with a 20-year mortgage. B. Fixed assets paired with accounts receivable. C. Owner's equity paired with notes payable. D. Current assets paired with marketable securities. What's your answer? Commit to one before I continue. The correct answer is D. Current assets paired with marketable securities. D is correct because marketable securities are a liquid, near cash holding that belongs in the current assets section, just below cash. The pairing is correct. A is wrong because a 20-year mortgage is a long-term liability, not a current liability. Current liabilities are obligations due within a year. B is wrong because accounts receivable is a current asset, not a fixed asset. Fixed assets are long-lived items such as plant and equipment. C is wrong because notes payable is a current liability, not owner's equity. Equity covers common stock, paid-in capital, and retained earnings. Every balance sheet question comes down to one skill: knowing which section an item belongs to. Master the map and classifying becomes automatic. Miss it and even easy questions turn into guesswork. There are 4 territories on the map. Current assets hold cash, receivables, and inventory that turn over within a year. Fixed assets hold long-lived property like plant and equipment. Liabilities hold what's owed, split into current and long-term. Owner's equity holds the ownership claim, stock, paid-in capital, and retained earnings. The rules reduce to timing and ownership. For an asset, ask if it converts within a year or serves the business for years. For a claim, ask if it's owed to an outsider or held by an owner, and if it's a liability, whether it's due soon or later. A 20-year mortgage is a long-term liability, not current because its due date is far off. Accounts receivable is a current asset, not fixed because it converts soon. Notes payable is a liability, never equity, even though it shares the same side of the sheet as ownership claims. The reliable habit is to classify by definition, never by proximity. Ask what the item is, when it converts or comes due, and whose claim it represents. And the correct section reveals itself every time. Question 21. A company reports cash $30,000. Marketable securities $15,000, accounts receivable $70,000, and inventories $90,000, along with several current liabilities. What is its gross working capital? Your options are A. $104,000, B. $205,000, C. $90,000, D. $115,000. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. $205,000. B is correct because gross working capital is simply total current assets with no liabilities subtracted, adding cash, securities, receivables, and inventories gives $30,000 plus $15,000 plus $70,000 plus $90,000, which is $205,000. A is wrong because the figure $160,000 leaves out the marketable securities or another current asset line. Gross working capital includes every current asset the company holds. C is wrong because the figure $90,000 is only the inventories. Gross working capital sums all four current asset lines, not just one of them. D is wrong because the figure $115,000 appears to net something out. Gross working capital subtracts nothing. It is the full total of current assets. Working capital gets its name from what it does. It's the capital that performs the daily work of running a business. Let's look at what gross working capital really means and why it's simpler than it seems. Gross working capital is simply the sum of a company's current assets, cash, marketable securities, accounts receivable, and inventories. That's the entire definition, pure addition with no liabilities subtracted anywhere. These assets are called working because they never sit still. Cash buys inventory, inventory becomes a receivable, and the receivable is collected back into cash. An operating cycle that fuels day-to-day business, unlike fixed assets that provide long-term capacity. The most common mistakes are netting out current liabilities, which gross working capital ignores entirely, or listing just one asset like inventory and calling it the answer. It's easy to blur this with net working capital, which does subtract liabilities, so reading the word gross carefully matters. Gross working capital equals total current assets, full stop. Measuring the liquid resource base a company puts to work. Add everything, subtract nothing, and you'll always get it right. Question 22. A company has current assets of $500,000 and current liabilities of $300,000, where the current liabilities include $80,000 of notes payable. What is the company's net working capital? Your options are A, $200,000, B, $20,000, C, $280,000, D, $4,500. Which would you go with? Lock it in before the reveal. The correct answer is A, $200,000. A is correct because net working capital is current assets minus current liabilities with no exclusions. That is $500,000 minus $300,000, which equals $200,000. The presence of notes payable inside current liabilities does not change this calculation. B is wrong because the figure $220,000 comes from excluding the $80,000 of notes payable, but net working capital uses all current liabilities. Excluding notes payable belongs to the NWC calculation, not net working capital. C is wrong because the figure $280,000 subtracts only part of the current liabilities. Net working capital subtracts the full $300,000. D is wrong because the figure $420,000 subtracts only the notes payable from current assets, which is not the definition. Net working capital removes all current liabilities. Net working capital asks a simple but pointed question. Once you subtract the bills coming due this year, how much breathing room does a company really have? The subtraction is total and unconditional. Every current asset, cash, securities, receivables, inventories, goes in on one side, and every current liability, including payables, accruals, and notes payable, comes out on the other. Nothing gets excluded from either side. Picture the full pile of current assets on one side and the full pile of current liabilities on the other. Net working capital is simply what remains after the second pile is subtracted from the first, note payable and all. The common mistake is borrowing an exclusion from a different measure. Net operating working capital deliberately removes notes payable and excess securities, but net working capital keeps them in. Pulling them out early just produces the wrong figure. Net working capital is the honest all-in comparison of current assets to current liabilities. Its defining feature is that it excludes nothing, which is exactly what keeps it distinct from the operating measure that comes later. Question 23. A company has cash $45,000, marketable securities $30,000, accounts receivable $220,000. and inventory is $260,000. On the liability side, it has accounts payable $150,000, accruals $40,000, and notes payable $90,000. What is its net operating working capital? Your options are A. $275,000, B. $305,000, C. $335,000, D. $365,000. Don't overthink it, which one feels right? The correct answer is C. $305,000. C is correct because operating current assets exclude the marketable securities. $45,000 plus $220,000 plus $260,000 equals $525,000. Operating current liabilities exclude notes payable. $150,000 plus $40,000 equals $190,000. Now C is $525,000 minus $190,000, which is $335,000. A is wrong because the figure $275,000 is net working capital, which keeps the securities and the notes payable in the totals. Now A removes both of those items. B is wrong because the figure $305,000 removes only one of the two excluded items. Now C must drop both the marketable securities and the notes payable. D is wrong because the figure $365,000 drops the notes payable, but keeps the marketable securities inside operating current assets. Both need to be excluded. Net operating working capital narrows the lens to operations alone, asking how much capital the core operating cycle itself ties up once financing and investment sideshows are stripped away. The formula is operating current assets minus operating current liabilities, where operating current assets are cash, accounts receivable, and inventories, and operating current liabilities are accounts payable and accruals. On the asset side, marketable securities drop out because parking surplus cash is an investment decision, not an operating necessity. On the liability side, notes payable drops out because short-term borrowing is a financing choice, not something the operating cycle generates on its own. First, build operating current assets by taking current assets and removing the marketable securities. Then build operating current liabilities by taking current liabilities and removing the notes payable, and subtract the second from the first. A rising figure relative to sales means operations are absorbing more cash that must eventually be funded. The reliable habit is to cross out marketable securities and notes payable before adding anything else, so they never sneak into the totals. Question 24. A reseller draws an extra $75,000 on its short-term line of credit, raising notes payable from $60,000 to $135,000, while cash, receivables, inventories, accounts payable, and accruals all stay the same. What happens to its net operating working capital? Your options are A. It rises by $75,000. B. It falls by $75,000. C. It rises by $135,000. D. It stays the same. Got a guess? Lock it in. The correct answer is D. It stays the same. D is correct because notes payable is never part of the NARC calculation, so changing it cannot move NARC. With every operating current asset and operating current liability unchanged, WC holds steady even though total current liabilities rose. A is wrong because WC does not rise because notes payable sits outside the formula entirely. The draw affects the current ratio, not NARC. B is wrong because WC does not fall either. A change in a non-operating financing item leaves operating working capital untouched. C is wrong because WC does not move by the new notes payable balance or by any other amount. That item simply is not in the calculation. Here's a result that feels wrong at first. A company can borrow a huge amount on its bank line, and its net operating working capital won't move at all. That's not a quirk. It follows directly from what the formula was built to measure. Net operating working capital is operating current assets minus operating current liabilities. Operating current assets are cash, receivables, and inventories. Operating current liabilities are accounts payable and accruals. Notes payable appears nowhere in that expression, because bank borrowing is a financing decision, not an operating one. Picture the balance sheet split in two, an operating zone and a financing zone. Notes payable lives in the financing zone, walled off from the calculation entirely. So no matter how much it grows, it simply cannot reach the operating figure. Drawing more on a credit line raises notes payable and cash, but a well-posed scenario holds the operating accounts fixed to isolate the point, with receivables, inventories, payables, and accruals unchanged. Net operating working capital cannot budge, even as the current ratio slips, because it does include notes payable. The lesson to carry forward: a change in notes payable is a non-event for net operating working capital every single time, because the measure exists to filter out financing decisions. Question 25. A company's accounts payable rises from $60,000 to $85,000 because it is buying more on supplier terms, while cash, receivables, inventories, accruals, and notes payable all stay the same. What happens to its net operating working capital? Your options are: A, it falls by $25,000. B, it rises by $25,000. C, it stays the same. D, it cannot be determined without net income. Which one is it? Pause the video if you need more time. The correct answer is A. It falls by $25,000. A is correct because accounts payable is an operating current liability inside the NOWC formula. So a $25,000 increase raises operating current liabilities by $25,000 and lowers NOWC by that same amount. More spontaneous supplier financing means less net capital tied up in operations. B is wrong because NOWC falls rather than rises. A larger operating current liability reduces the gap between operating current assets and operating current liabilities. C is wrong because NOWC does change here, unlike with notes payable. Accounts payable is part of operating current liabilities, so moving it moves NOWC. D is wrong because net income is irrelevant to this. NOWC depends only on the operating current asset and liability balances, which are all provided. Two liabilities, two very different effects. Accounts payable moves net operating working capital, but notes payable does not. And the reason comes down to one dividing line. Net operating working capital equals operating current assets minus operating current liabilities. Accounts payable sits inside that formula, but notes payable is excluded from it. An item inside the calculation changes the result. An item outside it cannot. When accounts payable rises, suppliers are financing a bigger share of the inventory, and receivables the company carries. That means the company itself has to supply less capital, so net operating working capital falls. A rising payable is the supply chain shouldering more of the load. Not all liabilities are equal in the eyes of this measure. Accounts payable and accruals are operating, so they move net operating working capital, while notes payable is financing, so it doesn't. The dividing line is operating versus non-operating, not liability versus asset. Reading a change in payables as a genuine reduction in the capital operations tie-up, rather than mere bookkeeping, is what separates true understanding from a memorized formula. Question 26. An analyst notes that net operating working capital deliberately leaves notes payable and excess marketable securities out of the calculation. What is the reasoning behind excluding both items? Your options are: A, both are long-term rather than current, so neither belongs in a working capital measure. B. Both are usually too small to matter for most companies. C. Both reflect financing or investment choices rather than operating necessities. D. Both are already counted inside accounts payable and accruals. Take a second. Which answer would you pick? The correct answer is C. Both reflect financing or investment choices rather than operating necessities. C is correct because no WC is meant to isolate the capital the operating cycle itself requires. Notes payable is a discretionary financing decision, and excess marketable securities is a non-operating investment decision. So both are stripped out to keep the measure about operations alone. A is wrong because both notes payable and marketable securities are current items, not long-term ones. Their exclusion is about being non-operating, not about maturity. B is wrong because size is not the reason. Even a large notes payable balance is excluded, because the aim is to remove financing choices, not small numbers. D is wrong because neither item is buried inside accounts payable or accruals. They are separate lines excluded on purpose because they are not operating items. Net operating working capital isn't just current assets minus current liabilities. It's a deliberate redesign that strips out two specific items. Understanding why they're excluded reveals the whole logic of the measure. Regular net working capital contaminates the operating picture with financing and investing decisions. Net operating working capital was built specifically to remove that contamination, isolating the business's true operating needs. Notes payable is excluded because borrowing is a financing choice, not something the operating cycle demands. Excess marketable securities are excluded because holding surplus cash to invest is an investing decision, not an operating necessity. A common mistake is thinking these items are excluded for being long-term, too small, or hidden inside other accounts. None of that is true. Both are clearly current and often large. The only real reason is that one is financing and the other is investing. Whenever you're deciding if an item belongs in net operating working capital, the question isn't whether it's current, it's whether it's operating. That single principle is the entire design behind the measure. Question 27. Which statement about net working capital and net operating working capital is correct? Your options are: A. They are two names for the same calculation and are always equal. B. WGU excludes notes payable and non-operating securities that net working capital includes. C. Net working capital always exceeds WGU for every company. D. NOWC applies only to companies that carry no debt. Before I reveal it, which one do you think is right? The correct answer is B. WGU excludes notes payable and non-operating securities that net working capital includes. B is correct because net working capital uses all current assets and all current liabilities, while NOWC removes notes payable from the liability side and excess marketable securities from the asset side. That difference in what each includes is the key distinction. A is wrong because the two are related but not identical. Because WGU excludes items that net working capital keeps, the two figures usually differ. C is wrong because there is no fixed direction to the difference, depending on the relative sizes of notes payable and excess securities. NOWC can be larger or smaller than net working capital. D is wrong because NOWC applies to any company, with or without debt. The calculation simply excludes notes payable when it is present. Net working capital and net operating working capital sound alike, but they're built differently and rarely give the same number from the same balance sheet. Both measures start from current assets and current liabilities. Net working capital subtracts every current liability, no exceptions. Net operating working capital first strips out notes payable and excess marketable securities and only then subtracts. Removing notes payable pushes the operating measure up, since a smaller subtraction leaves more behind. Removing marketable securities pushes it down, since there's less asset base to start with. Whichever removed item is larger decides which measure ends up bigger, so neither one is always on top. Picture the same balance sheet feeding two paths. One keeps everything and subtracts directly. The other filters out notes payable and marketable securities first. The filtered items are exactly why the two results usually don't match. Net operating working capital is simply net working capital, with financing and investing items filtered out. They usually differ, neither is reliably larger, and assuming a fixed ranking between them is the misconception to avoid. Question 28. Which of the following changes would directly increase a company's net operating working capital, holding everything else constant? Your options are A. Taking out a new short-term banknote, B. Paying down a long-term bond, C. Using idle marketable securities to repurchase shares, D. Increasing inventory while accounts payable stays flat. What's your answer? Commit to one before I continue. The correct answer is D. Increasing inventory while accounts payable stays flat. D is correct because inventory is an operating current asset, so raising it while operating current liabilities stay flat widens the gap between operating current assets and operating current liabilities, which increases note C. This is a genuine operating side change. A is wrong because a new short-term note changes notes payable, which sits outside the no WC formula. It moves the current ratio, not NARC. B is wrong because paying down a long-term bond touches long-term debt, which never enters NARC C. Operating working capital is unaffected. C is wrong because repurchasing shares with marketable securities moves non-operating items and equity, none of which are in the no WC formula. No WC does not change. Let's build a filter for testing whether a business change really moves net operating working capital or just looks like it should. Net operating working capital equals operating current assets, cash, receivables, and inventories, minus operating current liabilities, accounts payable and accruals. Only a change to one of these specific items can move the figure. Run the usual suspects through the filter. A new short-term banknote changes notes payable, paying down a bond changes long-term debt, and buying back shares with marketable securities touches a non-operating asset and equity. None of those accounts live in the formula, so none of them move it. The real mover is a change that touches an operating account with nothing operating offsetting it. Picture inventory rising while accounts payable stays flat. Operating current assets grow. Operating current liabilities don't, and the gap between them widens. So ask two questions. Is the changed item an operating current asset or liability? And did anything operating offset it? If it's non-operating, the figure holds still. If it's operating and unoffset, it moves up for an asset increase, down for a liability increase. Question 29. From a single balance sheet, an analyst computes gross working capital, net working capital, and net operating working capital and gets three different numbers. What best explains why all three differ? Your options are A. One of the three must have been calculated incorrectly since they should match. B. The company's balance sheet does not actually balance. C. Each measure includes a different set of items, so different figures are expected. D. The differences come from changes over time rather than from the formulas. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Each measure includes a different set of items, so different figures are expected. C is correct because gross working capital is all current assets. Net working capital subtracts all current liabilities, and NAR C subtracts only operating current liabilities from operating current assets. Because each formula includes a different set of items, 3 different results from the same balance sheet are normal. A is wrong because different results do not signal an error. The 3 measures are defined differently, so they are expected to diverge. B is wrong because whether the balance sheet balances has nothing to do with it. All 3 figures can come from a perfectly balanced balance sheet and still differ. D is wrong because all 3 are computed from the same single balance sheet at one instant. So time is not the source of the difference. The formulas themselves differ. Pull 3 working capital numbers from one balance sheet and you'll typically get 3 different figures. That's not a mistake or contradiction. The 3 measures are simply defined differently on purpose. Gross working capital is just total current assets, a pure sum with nothing subtracted. Net working capital subtracts all current liabilities from current assets. Net operating working capital goes further, removing notes payable and excess marketable securities before subtracting only the operating liabilities from the operating assets. Every gap has a specific source. Gross exceeds net by exactly the current liabilities that net subtracts, and net differs from the operating measure by the combined effect of excluding notes payable and excess securities. Every dollar of difference traces back to one specific item. These aren't competing answers to the same question. They're answers to 3 genuinely different questions. The size of the liquid base, overall near-term liquidity, and capital tied up in operations. When a problem yields 3 different results, the right reaction is recognition, not alarm. The definitions differ, so the numbers differ exactly as they should. Question 30. A commentator says a company has working capital problems, meaning its short-term obligations are catching up to the current assets available to cover them. Which measure most directly captures this concern? Your options are A. Net working capital, current assets minus current liabilities. B. Gross working capital, total current assets alone. C. Net fixed assets minus long-term debt. D. Retained earnings relative to common stock. Which would you go with? Lock it in before the reveal. The correct answer is A. Net working capital, current assets minus current liabilities. A is correct because the concern is whether current assets are enough to cover current liabilities, which is exactly net working capital. A thin or negative net working capital signals that current liabilities are approaching or exceeding current assets. B is wrong because gross working capital counts only current assets and ignores the obligations pressing against them, so it cannot show liabilities catching up. C is wrong because comparing fixed assets to long-term debt addresses long-term structure, not the near-term squeeze between current assets and current liabilities. D is wrong because retained earnings versus common stock describes the makeup of equity, not the relationship between current assets and current liabilities. When people in business warn that a company has working capital problems, they mean one specific thing: short-term obligations are closing in on the assets available to pay them. Net working capital is the cushion between current assets and current liabilities. When that cushion is comfortably positive, there's no trouble. But as it thins towards 0 or turns negative, the company may not be able to cover what it owes. Gross working capital counts only current assets and ignores the obligations pressing against them, so it can't register a squeeze at all. Net operating working capital deliberately excludes notes payable, one of the very obligations that can drive a liquidity crunch, so it misses part of the picture too. Picture a company whose current liabilities have grown steadily until they nearly equal its current assets. Its net working capital has shrunk to a sliver, leaving it one slow collection or unexpected expense away from being unable to pay what it owes. Common business language about working capital trouble is really language about near-term liquidity, captured by current assets minus current liabilities. That's net working capital, and it's the number that makes the danger visible. Question 31. A treasurer wants to know whether the company can cover the bills coming due over the next quarter using the assets it can quickly turn into cash. Which comparison speaks most directly to that concern? Your options are A. Current assets compared to sales. B. Net fixed assets compared to long-term debt. C. Retained earnings compared to common stock. D. Current assets compared to current liabilities. Don't overthink it. Which one feels right? The correct answer is D. Current assets compared to current liabilities. D is correct because comparing current assets to current liabilities is the liquidity question. Can near-term obligations be met with assets that will convert to cash soon? That is exactly what the treasurer is asking. A is wrong because current assets compared to sales measures efficiency, how productively assets generate revenue, not whether near-term bills can be paid. B is wrong because fixed assets versus long-term debt speaks to long-term capital structure, not the near-term ability to cover current obligations. C is wrong because retained earnings versus common stock describes the composition of equity and says nothing about covering near-term bills. Can a company cover what it owes soon using what it has on hand or coming in soon? That's the liquidity question, and it's answered one specific way, comparing current assets to current liabilities. Current assets are resources expected to become cash within the year. Cash, securities, receivables, inventory. Current liabilities are the bills due in that same window. When assets comfortably exceed liabilities, there's breathing room. When they don't, trouble is near. Picture it as a scale, current assets on one side, current liabilities on the other. Ratios like the current ratio and quick ratio are just structured versions of the same weighing, asking whether what can be turned to cash soon outweighs what must be paid soon. It's easy to reach for the wrong comparison. Current assets against sales measures efficiency, not solvency. Long-term assets against long-term debt speaks to capital structure. Neither answers whether bills get paid on time. Whenever a scenario asks whether a company can cover what it owes soon, that's the signal pointing to one relationship, current assets against current liabilities. Question 32. A manager wants to know how productively the company is using its receivables and inventory to generate revenue. To answer an efficiency question like this, current assets or their components should be compared to what? Your options are A. Current liabilities. B. Sales or net income. C. Long-term debt. D. The par value of common stock. Got a guess? Lock it in. The correct answer is B. Sales or net income. B is correct because efficiency asks how much revenue or profit the company draws from its liquid assets. So the right comparison is current assets, or components such as receivables and inventory against sales or net income. A is wrong because comparing current assets to current liabilities answers a liquidity question, whether bills can be paid, not how efficiently assets generate revenue. C is wrong because long-term debt relates to financing structure, not to how productively current assets produce sales. D is wrong because the par value of common stock is an equity detail unrelated to how efficiently working capital generates revenue. Once we know a company can pay its bills, a new question emerges. How hard is its money actually working? That question isn't about liquidity anymore. It's about efficiency. Liquidity compares current assets to current liabilities, asking whether the company is safe. Efficiency compares those same current assets or pieces of them to sales or net income, asking whether they're productive. Two companies can have identical liquidity yet wildly different efficiency. One might support the same sales using far less receivables and inventory. Only comparing assets to sales, not to liabilities, exposes that difference. Receivables measured against sales show how quickly customers pay. Inventory measured against sales shows how briskly goods move. Both connect an asset to the business activity it supports. The denominator you choose determines the question you're answering. Compare to liabilities for safety, compare to sales or income for efficiency, and recognizing which concern you're facing is half the battle. Question 33. Two companies each post $1,000 in sales. One supports those sales with $400,000 of current assets and the other with $200,000. Even if both can comfortably pay their bills, what does this difference most directly reveal? Your options are: A. They use their working capital with different efficiency. B. The first company is closer to insolvency. C. The second company must carry more long-term debt. D. The two companies must operate in different industries. Which one is it? Pause the video if you need more time. The correct answer is A. They use their working capital with different efficiency. A is correct because supporting the same sales with very different levels of current assets is an efficiency difference. One company generates identical revenue while tying up half the working capital. Comparing current assets to sales is the efficiency lens. B is wrong because the scenario states both can pay their bills, so this is not about insolvency. The contrast is in efficiency, not liquidity. C is wrong because nothing about current asset levels reveals the amount of long-term debt. The difference shown is how much working capital supports each dollar of sales. D is wrong because different working capital intensity does not require different industries. Even direct competitors can run different current asset levels for the same sales. Imagine two companies with identical sales, but one carries twice the current assets of the other. Both pay their bills fine, so neither faces a liquidity problem. The real difference between them is efficiency. The firm producing identical sales with less working capital is simply using its cash, receivables, and inventory more efficiently. Comparing current assets to sales is what reveals this efficiency gap, not any sign of financial distress. It's tempting to misread this gap as a warning sign, but it isn't. It says nothing about liquidity risk, insolvency, long-term debt, or even whether the firms are in different industries. Direct competitors can simply choose different working capital levels. This reflects a real management choice. Run lean with minimal cash and tight inventory, or run heavy with a generous cushion. If profits are similar, the leaner firm shows a stronger return on capital, since it achieves the same result from a smaller base. When sales are equal but current asset levels differ, the story is efficiency. How much working capital each firm commits per dollar of sales. Keep that frame, and you won't mistake a lean operation for one in trouble. Question 34. A specialty electronics retailer keeps minimal inventory on the floor, reorders only when nearly sold out, and requires payment in full or an approved credit check before extending any store credit. Which current asset investment policy does this describe? Your options are: A. Relaxed, B. Conservative, C. Restricted, D. Aggressive. Take a second. Which answer would you pick? The correct answer is C. Restricted. C is correct because lean inventory, tight reordering, and strict credit standards all point to holding few current assets relative to sales, which is the restricted policy. The behavior itself, not any label, gives it away. A is wrong because a relaxed policy carries generous inventory and loose credit. the opposite of what is described here. B is wrong because conservative is a financing policy term about how assets are funded, not an investment policy term about how much to hold. It is the wrong vocabulary for this question. D is wrong because aggressive is also a financing policy term, not an investment policy label. The lean type behavior described is a restricted investment policy. A company almost never announces that it runs a restricted current asset investment policy. Instead, it shows you through its behavior, and your job is to recognize the pattern and name the policy yourself. Minimal cash and securities means little idle liquidity. Tight inventory with quick reorder points means goods are never stockpiled. Strict credit standards and hard collection keep receivables small and fast turning. Every one of these behaviors traces back to the same choice. Hold as few current assets as possible relative to sales. Picture a specialty retailer with deliberately sparse shelves, restocking only when nearly sold out, and refusing store credit without payment in full or an approved check. None of these habits use the word restricted, yet every one of them points there. Here's the trap. Restricted, moderate, and relaxed describe investment policy, how much to hold. Aggressive and conservative describe financing policy, how to fund what's held, a completely separate decision. When a scenario about lean inventory and tight credit offers aggressive or conservative as answers, that's vocabulary borrowed from the wrong side of the equation. Translate conduct into policy and keep investment vocabulary separate from financing vocabulary. Spotting restriction from its fingerprints, rather than waiting for the word, is exactly what these problems reward. Question 35. A furniture wholesaler stocks 6 months of inventory ahead of demand. Offers 90-day payment terms to nearly any business customer that asks, and keeps a large cash and securities cushion just in case. Which current asset investment policy is this? Your options are A. Restricted, B. Relaxed, C. Aggressive, D. Maturity matching. Before I reveal it, which one do you think is right? The correct answer is B. Relaxed. B is correct because heavy inventory, liberal credit terms, and a large liquidity cushion together mean high current assets relative to sales, which is the relaxed policy. Each element points in the same direction. A is wrong because a restricted policy runs lean inventory and tight credit, the reverse of the generous stance described. C is wrong because aggressive is a financing policy term about funding mix, not an investment policy label describing how much to hold. D is wrong because maturity matching is a financing policy concept about aligning financing life with asset life, not a description of current asset levels. A relaxed current asset investment policy is the opposite of restriction, and just like restriction, it shows up in behavior, not in a label. A relaxed company carries large cash and securities balances, stocks generous inventory with high safety stock, and extends credit liberally with lenient collection. Together, these push current assets high relative to sales, earning it the nickname the Fat Cat policy. Picture a furniture wholesaler stocking half a year of inventory, waving through long payment terms for almost any customer, and keeping a fat cash balance on hand. Each habit points the same direction, abundant current assets relative to sales. The signature of a relaxed policy, the cushion lowers the risk of stockouts, lost sales, and cash crunches, but tying up so much capital in current assets drags on profitability. The exact reverse of the restricted trade-off. Relaxed and restricted are read the same way from behavior, but point in opposite directions. Generosity versus leanness in cash, inventory, and credit. Don't let financing terms like aggressive or conservative distract you from what the scenario actually shows. Question 36. All else equal, why does a restricted current asset investment policy tend to produce a higher return on equity than a relaxed policy? Your options are A. It raises the company's sales revenue directly. B. It increases the profit margin earned on each sale. C. It removes the need for any equity financing. D. It lowers total assets for a given sales level, raising asset turnover and therefore return on equity. What's your answer? Commit to one before I continue. The correct answer is D. It lowers total assets for a given sales level, raising asset turnover and therefore return on equity. D is correct because a restricted policy shrinks the current asset base, so total assets fall for the same sales and profit. That raises total assets turnover, which lifts return on assets and, with financing held constant, return on equity. A is wrong because a restricted policy does not raise sales. It can even risk losing some. The gain in return on equity comes from a smaller asset base, not more revenue. B is wrong because profit margin is unchanged by how many current assets are held. The improvement runs through turnover, not through margin. C is wrong because a restricted policy does not eliminate equity financing. It improves the return earned on whatever equity is invested by shrinking the asset base. Why does restricting current assets raise return on equity? Not through more sales or fatter margins, but through a smaller asset base supporting the same business. Total assets turnover measures sales generated per dollar of assets. Restricting current assets shrinks that asset base while sales stay the same, so turnover rises. Since return on assets combines margin and turnover, and return on equity builds on that, the whole chain climbs, holding financing constant. Picture two firms with identical sales and identical profit, both financed entirely with equity. The lean firm has a smaller asset base, so that same profit measured against less capital produces a higher return, maybe 10% versus 7% for the heavy firm. A firm trimming inventory, tightening credit, and holding less cash isn't raising sales or margin directly. It's shrinking the asset base needed to run the same business. And that's the real lever behind the rise in return. The DuPont equation later formalizes this exact logic. For now, remember, same profit, smaller base, higher return. Question 37. A company adopts a restricted current asset investment policy to lift its return on equity. What is the main risk it accepts in exchange? Your options are A. Stockouts, lost sales, and a thin cushion against unexpected cash needs. B. Higher interest costs from issuing long-term debt. C. Dilution of ownership from selling new shares. D. A lower return on equity than a relaxed competitor would earn. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Stockouts, lost sales, and a thin cushion against unexpected cash needs. A is correct because lean inventory raises the chance of stockouts. Tight credit can push marginal customers to competitors, and a thin cash cushion leaves little room for surprises. Those operating and liquidity risks are the price of the higher return. B is wrong because a restricted investment policy is about current asset levels, not about issuing long-term debt, so it does not by itself raise interest costs. C is wrong because cutting current assets does not involve selling shares, so ownership dilution is not the risk being accepted. D is wrong because a restricted policy is chosen precisely because it tends to raise return on equity, so a lower return is not the risk it creates. A restricted policy can boost return on equity, so why doesn't every firm run one? Because the same leanness that lifts returns also strips away the cushion that protects the business, and that missing cushion is a real risk. Low inventory can mean stockouts, turning a delayed sale into a lost customer. Tight credit standards can push marginal buyers to a friendlier competitor, and minimal cash leaves no slack when collections slow or a surprise bill arrives. Picture the balance sheet itself. Inventory, receivables, and cash all trimmed down. Each cut improves the ratios, but each one also removes a buffer that used to absorb ordinary business surprises. A restricted policy is not a free lunch. It raises expected return by shrinking the asset base, and it raises risk by removing the very buffers that base provided. Never treat the higher return as costless. A sound reading of the policy means recognizing that leaner books mean fewer safety nets when things go wrong. Question 38. Which situation would most likely push a company toward a more relaxed rather than restricted current asset investment policy? Your options are A. Highly predictable, stable customer demand. B. A management team with excellent demand forecasting. C. A competitive market where generous credit terms and in-stock availability win business. D. A strong desire to maximize short-term return on equity above all else. Which would you go with? Lock it in before the reveal. The correct answer is C. A competitive market where generous credit terms and in-stock availability win business. C is correct because when staying in stock and offering easy credit are what win customers, a company leans relaxed, accepting lower return on equity to protect sales. Competitive pressure of that kind favors a thicker current asset cushion. A is wrong because stable, predictable demand makes it safer to run lean, which points toward a restricted policy, not a relaxed one. B is wrong because strong forecasting reduces the need for buffers, again supporting a restricted stance rather than a relaxed one. D is wrong because prioritizing short-term return on equity favors shrinking current assets, which is the restricted policy, not the relaxed one. Choosing between a leaner and a more generous current asset policy isn't about one being universally right. The correct choice depends entirely on the conditions a company faces. A relaxed policy makes sense when running out of stock or refusing credit costs more than the return given up. In a competitive market, or when demand is volatile and seasonal, extra inventory and liquidity act as a cushion against lost sales. The opposite conditions favor restriction, highly predictable demand, strong forecasting, and a management team focused single-mindedly on maximizing return on equity or reduce the need for a cushion, making a leaner asset base the sound choice. Picture demand as a line that suddenly spikes. A relaxed buffer of ample inventory and cash absorbs that surge without disruption, while a lean buffer gets overwhelmed the moment volatility hits. The judgment worth developing is reading the environment first. Competitive pressure and volatile demand tilt relaxed, stability forecasting, and a return focused tilt restricted. And matching policy to conditions is what makes the answer thoughtful. Question 39. Under investor pressure to improve return on equity, a heavy equipment maker cuts its finished goods safety stock in half, tightens customer credit terms from net 60 to net 30, and sweeps idle cash into overnight investments daily instead of letting it sit for a week. These moves are best described as a shift toward which policy? Your options are A relaxed current asset investment policy. B. A restricted current asset investment policy. C. A conservative financing policy. D. An aggressive financing policy. Don't overthink it. Which one feels right? The correct answer is B. A restricted current asset investment policy. B is correct because less safety stock, tighter credit, and less idle cash all reduce current assets relative to sales, which is the restricted policy. Every change points toward holding less, the hallmark of restricting. A is wrong because a relaxed policy would build inventory, loosen credit, and hold more cash. The opposite of the moves described. C is wrong because conservative describes a financing choice about funding mix, not the current asset reduction shown here. D is wrong because aggressive is also a financing policy label. This scenario is about how much to hold in current assets, which is an investment policy question. Some scenarios don't describe a steady state. They describe a company changing direction, and your job is to read where it's heading. Cutting safety stock shrinks inventory. Tightening credit terms shrinks receivables. And sweeping idle cash trims the cash cushion. A shift is recognized not from one move, but from several moves aligned in the same direction toward holding fewer current assets. This alignment is usually driven by pressure to raise return on equity. Restricting current assets shrinks the asset base, and with sales and margin steady, that lifts turnover and ROE. A common distractor tries to relabel this as a financing decision, but financing is about how assets are funded, not how much to hold. Tightening inventory, credit, and cash is squarely investment policy. Several moves that all reduce current assets signal restriction. The return on equity motive confirms it, and keeping investments separate from financing keeps you in the right vocabulary. Question 40. On an exam, a scenario clearly describes a company holding heavy safety stock, offering loose credit, and keeping a large cash buffer, yet a student picks moderate simply because it sounds safest. What is the flaw in that reasoning? Your options are: A. Moderate is never a valid answer on these questions. B. The described behavior actually points to a restricted policy. C. Moderate and relaxed are the same policy under different names. D. The described behavior points to a relaxed policy, so moderate is the wrong match. Got a guess? Lock it in. The correct answer is D. The described behavior points to a relaxed policy, so moderate is the wrong match. D is correct because the task is to match the policy to the behavior, and heavy stock, loose credit, and a big cash buffer describe a relaxed policy. Defaulting to moderate because it feels safe ignores what the scenario actually says. A is wrong because moderate can be correct when a scenario describes neither extreme. The flaw here is that this scenario does describe an extreme, the relaxed one. B is wrong because the behavior is generous holding, not lean holding, so it points to relaxed, not restricted. C is wrong because moderate and relaxed are distinct policies. Moderate sits between the extremes, while relaxed is the high current asset extreme. There's a specific wrong instinct these problems are built to punish. Picking moderate because it sounds safe, without checking whether the scenario actually describes the middle. Restricted, moderate, and relaxed are three real positions on a spectrum. Moderate is only correct when the described behavior genuinely splits the difference between lean and generous, not simply because it's the middle-sounding label. Moderate sounds balanced and balanced sounds safe. So under time pressure, it's tempting to grab it as a hedge. But the exercise tests whether you can match a described policy to its actual position, and that position is often an extreme. Picture a company stocking abundant inventory, extending easy credit, and sitting on a large cash reserve. That combination is the signature of relaxed, sitting at one end of the spectrum, not the comfortable middle. Read the specific behaviors, place them on the spectrum from lean to generous, and name the policy they actually describe. That discipline, not the comfort of the middle, is what these problems are testing. Question 41. A company's fixed assets and a baseline of current assets stay on its books all year, but its inventory and receivables balloon only during a 3-month peak selling season. The seasonal balloon amount is best described as what? Your options are: A. Permanent current assets. B. Net fixed assets. C. Temporary current assets. D. Spontaneous liabilities. Which one is it? Pause the video if you need more time. The correct answer is C. Temporary current assets. C is correct because the seasonal bulge that rises above the year-round floor and then recedes is, by definition, Temporary current assets. It appears only during peak activity and disappears once the peak passes. A is wrong because permanent current assets are the baseline that stays on the books all year, not the seasonal spike. The balloon is the part that comes and goes. B is wrong because net fixed assets are long-lived productive assets, such as plants and equipment, not seasonal inventory and receivables. D is wrong because spontaneous liabilities are obligations such as payables and accruals. The balloon described sits on the asset side, not the liability side. Picture a lawn and garden equipment maker's balance sheet in January versus May. Inventory and receivables sit low in winter, then balloon in spring as mowers and tillers fly off the shelves. That seasonal bulge rising and falling with demand is what we call temporary current assets. Temporary current assets are still cash, inventory and receivables in every ordinary sense. What sets them apart is timing. They appear when demand surges and vanish when it subsides, tracing the shape of the business cycle. Split the current asset base into two layers. A permanent floor of minimum inventory and receivables persists all year to serve regular customers, while the temporary layer stacks on top only during the peak selling season. The sorting matters because it sets up financing decisions. Fixed assets are plant and equipment. The permanent floor is a year-round commitment, and the temporary bulge, existing for only a few months, calls for short-term financing rather than long-term commitments. Whenever you see language about seasonal swings or accounts that balloon and recede, that's the signature of temporary current assets, distinct from both the permanent floor beneath them and fixed assets entirely. Question 42. Which of the following best defines permanent current assets? Your options are: A. The baseline level of current assets a company needs even at the low point of its operating cycle. B. Fixed assets that are never depreciated. C. Current assets that are financed only with short-term debt. D. Assets held for more than 10 years as long-term investments. Take a second. Which answer would you pick? The correct answer is A. The baseline level of current assets a company needs even at the low point of its operating cycle. A is correct because permanent current assets are the floor of cash, inventory, and receivables a business needs year-round, even at its slowest point. The balance never falls to zero, though it may grow slowly as the company grows. B is wrong because permanent current assets are current assets, not fixed assets, and the term has nothing to do with depreciation. C is wrong because the label describes a baseline level of assets, not how those assets are financed. Financing is a separate decision entirely. D is wrong because permanent does not mean long-term. These assets still cycle through cash, inventory, and receivables within the operating period. They simply never disappear completely. Even in its slowest season, a business still needs some cash, some inventory, and some receivables just to keep running. That irreducible baseline is what we call permanent current assets. The word permanent is the source of most confusion, so let's rule out the wrong readings first. Permanent current assets are not long-term, not fixed assets, not defined by how they're financed, and not held untouched for years. Picture that lawn and garden maker in the depth of winter. Sales slow to a trickle, but it still keeps a minimum stock of parts, some receivables from off-season work, and enough cash to keep the lights on. That winter minimum is the permanent layer, persisting through the trough and slowly growing as the business grows. Stack total current assets over the year and you see two layers: a temporary layer that bulges and shrinks with the seasons. Sitting on top of the permanent layer, the floor that never disappears. So keep this straight. Permanent current assets are the year-round floor of the current asset base, still cycling like any current asset but never falling to zero. That baseline plus the temporary bulge above it is what financing decisions are built on. Question 43. A chief financial officer says, we deliberately match how long our financing lasts to how long we will need the asset it is paying for. Which principle is being described? Your options are A. The DuPont equation, B. A restricted investment policy, C. The accounting equation, D. Maturity matching. Before I reveal it, which one do you think is right? The correct answer is D. Maturity matching. D is correct because aligning the life of the financing with the useful life of the asset it funds is maturity matching, also called the self-liquidating principle. The financing comes due about when the asset stops generating cash. A is wrong because the DuPont equation breaks return on equity into margin, turnover, and leverage. It does not describe matching financing life to asset life. B is wrong because a restricted investment policy is about holding few current assets, not about timing financing to asset life. C is wrong because the accounting equation states that assets equal liabilities plus equity. It is an identity, not a financing timing principle. Maturity matching, also called the self-liquidating principle, says financing should come due at roughly the same time the asset it pays for stops generating cash. The self-liquidating label captures the mechanism nicely. A seasonal inventory buildup funded with a short-term loan is the model case. The inventory sells, the cash comes in, and the loan is repaid, all on the same seasonal clock. So the asset effectively liquidates itself. Violate the principle in either direction and problems follow. Fund a long-lived asset with short-term debt, and the company must refinance again and again, risking non-renewal or repricing each time. Fund a short-lived seasonal asset with long-term debt, and the company keeps paying interest long after the asset and its cash are gone. In practice, a manager funds equipment expected to serve for years with long-term financing and funds a 2-month inventory bulge with a short-term loan repaid when the season ends. Each asset is paired with financing whose life matches its own. Remember, maturity matching is about timing, not dollar amounts. It doesn't require current assets to equal current liabilities. It minimizes refinancing risk, not necessarily cost, by keeping financing life and asset life in step. Question 44. A construction firm buys a crane it will use for 12 years and finances it with a 90-day banknote it plans to roll over every quarter for as long as it owns the crane. What is the principal danger of this arrangement? Your options are A. The interest rate on short-term debt is always higher than on long-term debt. B. The firm must refinance repeatedly and a lender could refuse to renew or reprice sharply at a bad moment. C. Short-term debt cannot legally be used to purchase a fixed asset. D. The crane will have to be reclassified as a current asset. What's your answer? Commit to one before I continue. The correct answer is B. The firm must refinance repeatedly and a lender could refuse to renew or reprice sharply at a bad moment. B is correct because funding a 12-year asset with 90-day debt forces dozens of renewals over the asset's life. Each renewal is a moment a lender could decline or demand a much higher rate, regardless of how well the crane performs. That rollover risk is the core danger. A is wrong because short-term rates are usually lower than long-term rates under a normal yield curve. So the problem is not a higher rate. The problem is the repeated refinancing. C is wrong because there is no legal bar to using short-term debt for a fixed asset. The issue is the risk created by the maturity mismatch, not legality. D is wrong because how an asset is financed does not change its classification. A crane used for years remains a fixed asset regardless of the loan term. A construction firm buys a 12-year crane using a 90-day note, planning to simply roll it over every quarter. Short-term borrowing looks cheaper but underneath the firm has created a serious and avoidable danger. Financing a 12-year asset with 90-day notes means refinancing roughly 48 separate times. Each renewal date is a chance for the lender to refuse or to demand a much higher rate, no matter how well the crane itself is performing. Picture the crane's 12-year life as one long, unbroken timeline. Now picture the financing beneath it chopped into dozens of tiny 90-day segments, each one a fresh moment of exposure. Several explanations seem plausible but miss the point. It is not that short-term debt costs more, it usually costs less. It is not illegal, and it does not change how the crane is classified. The one genuine hazard is rollover exposure itself. The fix is maturity matching. Finance the crane with long-term debt, or a lease that spans its full 12 years. That locks in the rate and funding for the asset's life, erasing over a decade of dangerous renewal dates. Question 45. Under a moderate maturity matching financing policy, how is a company's seasonal, temporary current asset need typically financed? Your options are A. With long-term bonds issued once and never repaid. B. With new common stock sold each season. C. With short-term debt drawn during the peak and repaid as the peak subsides. D. With retained earnings exclusively. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. With short-term debt drawn during the peak and repaid as the peak subsides. C is correct because maturity matching funds the temporary, self-liquidating bulge with short-term debt that is drawn as the seasonal need arises and paid down once the season passes. The financing life matches the short life of the asset. A is wrong because long-term bonds never repaid would leave the firm paying interest all year for an asset that exists only a few months, the opposite of maturity matching. B is wrong because issuing stock each season is impractical and would fund a short-lived need with permanent capital, again violating maturity matching. D is wrong because retained earnings is long-term capital better suited to permanent needs. Under maturity matching, the temporary bulge is funded with short-term debt. The moderate financing policy is the textbook version of maturity matching. It pairs each asset with financing whose life fits it exactly, which is what makes it moderate rather than aggressive or conservative. Long-term capital, meaning long-term debt, equity, and spontaneous financing, funds whatever stays, fixed assets, and the permanent layer of current assets. Short-term debt funds only what comes and goes, the temporary, seasonal current assets that bulge at peak season. This is the self-liquidating idea in action. Temporary inventory sells, receivables get collected, and that cash retires the short-term loan on the same seasonal clock. The financing lasts exactly as long as the asset it supports, so no interest is paid once the season ends. Funding a 2-month bulge with long-term bonds means paying interest for 10 idle months, and issuing stock each season would tie a permanent source to a fleeting need. Only short-term debt, drawn and repaid on the seasonal schedule, fits the temporary asset's short life. Under the moderate policy, long-term capital funds fixed and permanent current assets, while short-term debt funds only the temporary bulge, drawn at the peak and repaid as it passes. That pairing of permanent with permanent and temporary with temporary is maturity matching in practice. Question 46. A company finances part of its permanent current assets with a revolving short-term line of credit that it never fully pays off, renewing it indefinitely to take advantage of low short-term rates. This is an example of which financing policy? Your options are A. An aggressive financing policy. B. A conservative financing policy. C. A moderate maturity matching policy. D. A relaxed investment policy. Which would you go with? Lock it in before the reveal. The correct answer is A, an aggressive financing policy. A is correct because using short-term debt to fund part of the permanent asset base, renewed indefinitely, is the aggressive financing policy. It leans on cheap short-term money for assets that never actually leave the balance sheet. B is wrong because A conservative policy would fund the permanent base entirely with long-term capital, not with a perpetual short-term line of credit. C is wrong because maturity matching funds only the temporary bulge with short-term debt and covers the permanent base with long-term capital. So this arrangement is more aggressive than that. D is wrong because relaxed is an investment policy term about how much to hold, not a financing policy label about how assets are funded. An aggressive financing policy makes a calculated bet. It uses cheap short-term debt to fund not just seasonal swings, but part of the permanent asset base, and sometimes even fixed assets. That reach past the temporary layer into assets that never go away is the defining move. Under maturity matching, short-term debt stops at the temporary layer. An aggressive firm pushes further, funding permanent current assets, and in extreme cases fixed assets, with short-term borrowing that must be renewed indefinitely, since the underlying assets never go away. The motive is cost. Under a normal upward-sloping yield curve, short-term rates sit below long-term rates. So leaning on short-term debt lowers the average cost of capital. But that means constant rollover. And if a lender refuses to renew or rates spike, the firm is exposed exactly where it can least afford to be. Picture a company funding part of its permanent current assets with a revolving short-term line of credit it never fully pays down, renewing it again and again to chase the lower short-term rate. That permanence of the asset paired with the short life of the debt is the tell. Aggressive is a financing label, not an investment one, so don't confuse it with restricted or relaxed policies, which describe how much to hold rather than how to fund it. Its signature is cheap short-term money stretched to cover permanent assets, cheaper on average, riskier in a crisis. Question 47. A company issues enough long-term debt and equity to cover its fixed assets, its full permanent current asset base, and even part of its usual seasonal inventory buildup, turning to short-term debt only in the most extreme peak weeks. This describes which policy? Your options are A, an aggressive financing policy, B, a restricted investment policy, C, a relaxed investment policy, D, a conservative financing policy. Don't overthink it. Which one feels right? The correct answer is D, a conservative financing policy. D is correct because funding fixed assets, the entire permanent floor, and part of the temporary bulge with long-term capital, while using short-term debt only at the extreme peak, is the conservative financing policy. It minimizes reliance on short-term borrowing. A is wrong because an aggressive policy leans more heavily on short-term debt, even for part of the permanent base, which is the reverse of this arrangement. B is wrong because restricted is an investment policy label about how much to hold, not a description of the financing mix. C is wrong because relaxed is likewise an investment policy term, not a financing policy. This scenario describes how assets are funded, which is a financing decision. Safety is the organizing idea behind conservative financing. This policy deliberately uses long-term capital to cover more than it strictly needs to. It funds all fixed assets and the entire permanent current asset base with long-term money, exactly as maturity matching would, but it goes further, using long-term capital to pre-fund part of the temporary seasonal bulge too, calling on short-term debt only at the very peak, if at all. Picture the asset base as layers: fixed assets, permanent current assets, and a seasonal bulge on top. In the conservative policy, long-term capital climbs up through all of it, leaving only a thin sliver at the very peak to be covered by short-term debt. This buys safety by minimizing rollover risk and locking in funding well ahead of need, which suits a firm that prizes certainty over cost, but that safety isn't free. Long-term capital costs more, and during the slow season, the firm carries idle funds, often parked in marketable securities that it doesn't yet need. The conservative policy funds fixed assets or permanent current assets, and part of the temporary layer with long-term capital, relying on short-term debt only at the extreme peak. It's a financing label, not an investment one, and its signature is safety bought at a price. Question 48. Why does an aggressive current asset financing policy typically carry a lower average financing cost but higher risk than a conservative policy? Your options are: A. Short-term debt never has to be repaid, so it costs nothing. B. Short-term rates are usually lower than long-term rates, but short-term debt must be refinanced repeatedly, creating rollover and rate risk. C. Long-term debt is tax-exempt, so avoiding it lowers both cost and risk. D. Aggressive policies avoid interest expense entirely. Got a guess? Lock it in. The correct answer is B. Short-term rates are usually lower than long-term rates, but short-term debt must be refinanced repeatedly, creating rollover and rate risk. B is correct because under a normal yield curve, short-term rates sit below long-term rates, so leaning on short-term debt is cheaper on average. The catch is that short-term debt must be renewed again and again, exposing the borrower to refusal or repricing, which is the added risk. A is wrong because short-term debt absolutely must be repaid or refinanced when it comes due. Its cost advantage comes from lower rates, not from never repaying. C is wrong because long-term debt is not generally tax-exempt and avoiding it does not lower risk. The aggressive policy accepts more risk in exchange for lower cost. D is wrong because an aggressive policy still pays interest, just usually at lower short-term rates. It does not eliminate interest expense. In financing policy, cost and risk don't move together the way you'd expect. The cheaper choice is actually the riskier one, and the safer choice costs more. Short-term debt is cheap because lenders demand less compensation for parting with money briefly, but that low price hides exposure the borrower is quietly accepting. Short-term debt carries rollover risk, since a lender can refuse to renew or demand a steep rate hike exactly when the firm is weakest. It also carries interest rate risk, since frequent resets make interest expense unpredictable. Long-term debt costs more precisely because it locks in both the rate and the availability of funds. The aggressive policy chases the lower short-term rate and accepts rollover and rate risk in return. The conservative policy pays up for long-term certainty, sometimes sitting on idle cash. The moderate policy just matches financing life to asset life without trying to profit from the yield curve. Never assume the cheap option is also the safe one. The discount on short-term debt is simply compensation for the extra risk the borrower agrees to carry. Question 49. A firm wants to minimize the refinancing and rollover risk on the debt funding its current assets, even if that means giving up some of the cost advantage of short-term borrowing. Which approach should it lean toward? Your options are: A conservative or maturity matching financing policy. B, an aggressive financing policy. C, a restricted investment policy. D, a relaxed investment policy. Which one is it? Pause the video if you need more time. The correct answer is A, a conservative or maturity matching financing policy. A is correct because leaning on long-term capital, as a conservative or maturity matching policy does, reduces how often the firm must return to lenders and locks in rates and availability. That directly lowers rollover and refinancing risk at the cost of paying more on average. B is wrong because an aggressive policy relies more on short-term debt, which raises rollover risk rather than minimizing it, the opposite of the firm's goal. C is wrong because restricted is an investment policy choice about how much to hold, not a way to manage the refinancing risk on the firm's debt. D is wrong because relaxed is also an investment policy label, unrelated to reducing the rollover risk on financing. When a firm's top priority is avoiding a bad moment refinancing, its financing policy choice follows directly from one idea, where rollover risk actually comes from. Rollover risk grows with reliance on short-term debt, because every dollar of it must be resecured when it comes due, and each renewal is a chance for a lender to refuse or reprice. Long-term capital locks in the rate and availability for years, sharply cutting how often the firm must return to lenders. The conservative policy funding even part of the seasonal layer with long-term capital carries the least rollover risk. Maturity matching, which never funds permanent assets with short-term debt, carries far less risk than the aggressive approach, though both trade higher costs for fewer dangerous renewal dates. Picture the balance sheet. The more of it funded long-term, the fewer anxious renewal moments a firm faces, and the lower its rollover risk becomes. Minimizing rollover risk means leaning conservative or maturity matching, paying a higher average financing cost in exchange for far less exposure to a lender's refusal or a rate spike at the worst possible time. Question 50. Under a conservative financing policy, a firm sometimes holds marketable securities during its slow season. What best explains this? Your options are: A. The law requires firms to hold securities during slow periods. B. Marketable securities are a form of current liability the firm must carry. C. The firm raised more long-term capital than its off-season needs require, and parks the excess until activity picks up. D. The firm is deliberately trying to maximize its rollover risk. Take a second. Which answer would you pick? The correct answer is C. The firm raised more long-term capital than its off-season needs require and parks the excess until activity picks up. C is correct because a conservative policy funds more than the permanent floor with long-term capital. So during slow periods, some of that capital is not yet needed in operations. The firm parks the surplus in marketable securities until the next seasonal ramp-up. A is wrong because no law requires holding securities during slow periods. The holding is a byproduct of raising ample long-term capital in advance. B is wrong because marketable securities are a current asset the firm owns, not a liability it must carry. D is wrong because firms try to reduce rollover risk, not maximize it. The conservative policy already minimizes that risk by relying on long-term capital. Here's a puzzle. Why would a conservatively financed company hold marketable securities during its slow season instead of putting that money to work? The answer isn't speculation or some rule. It's simply a natural byproduct of raising more long-term capital than the off-season actually needs. Recall what the conservative policy actually funds with long-term capital: the fixed assets, the entire permanent current asset base, and even part of the seasonal temporary layer. During the slow season, that seasonal portion has nothing to fund, so the capital raised for it just sits idle. A well-run firm won't let idle money sit earning nothing. It parks the surplus in safe, liquid, short-term securities, earning a modest return while staying ready to be pulled back the instant the seasonal ramp-up starts. Picture the firm's capital structure. Long-term funds cover fixed assets, the permanent base, and a slice meant for the seasonal peak. When that peak hasn't arrived, the earmarked slice has nothing to fund yet, so it becomes marketable securities waiting. This clears up common misreadings. The securities aren't required by law, aren't a liability, and don't signal more risk taken. The conservative policy exists to minimize rollover risk. They're simply surplus cash, an asset parked safely until the seasonal build-up calls it back into service. That brings our Q&A on Domain 1, Working Capital and the Balance Sheet, to a close. To put all of this into practice, head over to our website using the link in the description below. There, you'll find hundreds of free practice questions waiting for you, along with complete detailed study guides. Together, these resources are designed to support and strengthen your preparation, guiding you every step along the way. Hit subscribe for the next video and good luck on your financial management exam.